he will try to react and tighten again. When he tightens again and mortgage rates are already at 7%, where is he going to send his mortgage rates? Where is he going to send his corporate borrowing rates? To 7 to 8%. And so more corporates and more households over time will be forced to face these higher and higher interest rates. And that's bound to break the economy at some point. So it might seem that this fiscal deficit helps the private sector, but if you instead use it at the wrong time, you only increase the inflation risks, you increase the reaction of the Federal Reserve, and ultimately you will hurt the consumers. So I think there is a risk there. Where I don't agree necessarily is this UK comparison, because the US issues the global reserve currency of the world. That's the dollar. Everybody needs dollars. Everybody wants dollars. In Brazil, they're selling soybeans in dollars. In China, they're selling goods and services in dollars. We have built a system around the dollar. We haven't built a system around the British pound, the sterling. So that's why when you play with fire in the UK, you get these bond vigilantes reactions. They're much harder to get in the US, but what you could get is inflation instead in the US. What the dollar will do in that case, it'll suck the system, it will deleverage the system, it will force everybody who has borrowed in dollars. As interest rates go up in the US, as inflation goes up in the US, it will make the dollar strengthen because the cost of debt that has been issued in dollar will move up. And so all these companies outside the US that have borrowed in dollars will have a very hard time repaying their dollar liabilities. So the dollar will work as a black hole that will suck and deleverage the entire system until it basically is forced to implode, and then we need an alternative. So the way to break the dollar system, funnily enough, isn't an orderly way where you slowly walk away from the dollar. If you want to break the system based on the dollar, you have to face the monster in the eye, make the dollar suck the system, deleverage the system like a black hole. It's a very disruptive force. It's not an orderly unwind. But it might happen as a result of higher interest rates, higher inflation, pushing all the indebted countries and companies in dollar outside the US, force them to repay their dollar debt, to deleverage, to shrink their balance sheet, and basically to destroy the system from the within. But it is not an orderly de-dollarization.
Yep,
it could happen. And if you think of ways you can break a global reserve currency system, look at the past. How have we done that? Normally with disruptive events, with wars, with a system breaking from within. Think of the Roman Empire, for example. It broke from within. Think of other global reserve currencies. They basically fell because they lost a war. So there are always disruptive elements in breaking a global reserve currency. My point is, yes, it could happen. I'm not sure whether in the next 10, 20, or 50 years. But my main point is, it isn't going to be orderly. It's not going to be this fairy tale where you dethrone the dollar and everyone is happy. It will be a disastrous type of setup where the system has to implode from within. Why? We have $12 trillion of outstanding debt that has been issued from entities, countries, companies outside the US. So they issue dollar debt, they lever up, they borrow in dollars, but they can't get their hands on dollars. They cannot unless they're selling goods, they're selling services, they're selling commodities in dollars. So what happens when the dollar appreciates and the global economy slows is that your debt that are denominated in dollars, they go up in value. So you have to pay more to service your debt. But what about your assets? What about your cash flows? If you're not selling stuff because the economy is slowing down, you're in trouble. And that's why during periods of crisis, we see the dollar appreciating. Again, you need a disruptive environment. You need something that disrupts the system from within. So it could be extreme deflation, because that basically increases the value of debt. If you have deflation, the real value of your debt goes up. It could be a high inflation prolonged for a period of time, forces the Federal Reserve to raise interest rates, which again breaks the system from within. Or it could be another type of event, like, we had a pandemic and then authorities came in and did fiscal deficits and reacted. What if we have a war or anything like that? I think America is very productive, is one of the economies that is the center of excellence for technological production, for example. Think of artificial intelligence right now, for instance. But the policymaking mix that we are applying right now is completely irrational and very risky. So this permanent use of fiscal deficits, which seems to be this easy win for politicians. They think, let's throw money at the economy year after year, let's win elections this way. This is very risky. But structurally, the US economy is pretty sound. It's productive. Americans are hard workers and companies are productive. I mean, think of artificial intelligence, think of all the tech companies that were founded in the US. But if we keep applying this policy making mix that is very risky and irresponsible, this could ruin the entire texture of the US productive system. I think that what has happened is that investors have completely thrown in the towel on a recession. Recession was priced at 30 to 40% chance after the banking turmoil in 2023. And now, if I look at the bond market, which I track very closely, the bond market is now pricing only a 10% chance of a recession over the next 12 months. Only 10%, okay? So 10% isn't zero, but it's a very low probability priced in markets today. And instead, if you look at where the economic cycle is going, as we speak, you start to see the first signs that there is some potential weakness in the labor market. If you see the amount of full-time jobs that are being added by the US economy, it is coming down. If you see the amount of jobs added by the cyclical sectors of the economy, the ones more reactive to how the economy is doing, cyclical industries like manufacturing, transportation, or trade, they are not really hiring anymore. So you are seeing the first signs, right, that the hiking cycle of the Fed is playing a bit of its weakening role on the economy, yet bond markets are not believing anymore into a recession. So right here, I think you have this opportunity of looking at this front end of the bond market. 2 to 5 year bond yields are still offering north of 4% yields that investors can look at, lock them in, and what they offer is this optionality that if the situation deteriorates, you are making money on these bonds you bought, and when there is blood on the streets, or as Warren Buffett used to say, when people are fearful, then you have an opportunity to be greedy. But right now, people aren't fearful. Right now, the market is greedy. Right now, you have NFTs of penguins and monkeys being bought for $500,000 each. You have strange meme coins going up 9,000% over the weekend. It's full animal spirits. When it's full animal spirits, you're supposed to be more careful. What's happening is that the market is looking at stuff like 1995 or 2007 or 1999. They're looking at a situation where the Federal Reserve has raised rates, and also in 1999 and 2007, interest rates were over 5%, like today. The Fed has raised rates, but the economy seems to be able to handle it. So people are like, whoa, let's go. Something has changed. I can now put risk at work. I feel more confident. And they're looking at their neighbors getting richer. This is a concept that they're looking at something I would call the neighbor tracking error. So tracking error is this concept in finance where you're tracking a benchmark, but there is an error, and you are now having a neighbor tracking error. Your neighbor has Nvidia, your neighbor has other AI-driven stocks, he has Bitcoin, you don't. So what? So you're going to chase him. You're going to feel poor and you want to chase what your neighbor is doing, right? And everybody's piling into the same animal spirits behavior, even if they have an alternative. They have an alternative. It's 5% risk-free interest rates. Nobody cares. So this is animal spirits. I like gold more from, let's say, a monetary perspective than I like Bitcoin. Right. I have a valuation framework on gold. And what I do is the following. Look, gold for centuries has been considered an alternative, a coexistent alternative to fiat money, okay? So then, how do I value the price of gold? Is $2,000 enough, or is $2,500 the fair price for gold? So what I do is I take all the gold on earth, okay, and I apply the price of gold on top of it. So I calculate the market capitalization of the gold market. How much is the gold market worth and value today? The answer is about $7 trillion as we speak, okay? That's price of gold times the amount of gold on earth. It's worth about $7 trillion. Should it be worth more or less? It's pretty simple. How does that $7 trillion worth of gold compare to the amount of fiat spendable money in the system? How much fiat money is out there in the 5 largest economies in the world? And the answer is $35 to $40 trillion. So the valuation of gold is about 20% of the valuation of the fiat money in existence in the 5 largest economies in the world. And if you look at this ratio, it has always been around 20%. Investors have always valued gold as a good alternative to fiat money, priced at about 20% of the fiat money in existence in the 5 largest economies in the world. If you do that math today, the fair value of gold is about $22,000 to $23,000 per ounce. Now, wait a second. If you do 20% of the fiat money in existence, the fiat money in existence goes up over time and up and up and up. We print every time new money, right? We make new debt, we print new money. So if this denominator goes up over time, then also the price of gold will climb over time to maintain this 20% ratio that I calculated. So basically in 5 years from now, the fair value of gold, if we keep printing fiat money, won't be 2,200 anymore, it will be 3,000, and so on and so forth, and so on and so forth. That's why gold appreciates over time, because it's a hard asset that is priced as an alternative to this fiat money that we keep printing over time. Over time, yes, if you're a patient investor and you are looking 5 to 10 years ahead, gold is likely to trade about above $2,500, possibly at $3,000 in about a decade from now. Of course, gold shouldn't be the only thing you own in a portfolio, because gold does not produce cash flows, right? There will be certain type of stock investments that are solid companies, not leveraged, they are reliable, they have good business models, and they will produce cash flows over time. But gold deserves a role in a portfolio because not only it has this property of being priced as an alternative to fiat money, and it appreciates over time, but it's also a hedge, because if ever this fiat money system gets challenged, gold is in the primary position to be the new monetary reference asset, because it already sits at the epicenter of our system. All the largest central banks in the world own gold. All the largest governments in the world own gold. So it will play that role again.